Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks edging higher after the Fed holds rates, saying inflationary effects from President Trump's trade war will be transitory and recession risks are not high. Goldman Sachs, though, says tariffs are among the issues top of mind for Asia-Pacific equity investors. We'll get analysis with their chief regional strategist, Tim Moe. The Philippine Central Bank chief also warning of uncertainty around trade and tariffs. We'll hear exclusively this hour from Remolona. Plus, we'll meet the Pakistani government's new crypto advisor and ask how he's planning to integrate blockchain and digital assets into the country's financial system. Welcome to Insight. Copper prices have surpassed $10,000 a ton on the LME due to global trade dislocation triggered by President Trump's push for tariffs on the metal. But Asian stocks are gaining for a fifth day following a rally on Wall Street. That's after the Fed chief signaled that any inflation due to tariffs will be brief, using that controversial word, transitory, once again.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Chair Powell also didn't discount the possibility of a recession this year, but he calmed investor nerves by saying the chances are not high.
If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Let's dive straight into the market impact with Tim Moe, Chief Asia Pacific Regional Equity Strategist at Goldman Sachs. Good to have you with us.
It's a pleasure to be here.
I'm not getting it, right? He says chances of recession is higher, but he's not too concerned. But if you speak to the likes of Larry Summers, he puts it at 50%. That's pretty high.
Yeah, I mean, that's what makes a market. There are different views. Just to level set things, we recently raised, our U.S. economics team recently raised their subjective forecast for a recession in the next 12 months from 15% to 20%. I want to remind you that 15 is what you would expect if you woke up and didn't know anything about the economy, because on average there's been a recession once every 7 years, and so that's 15%. So we ticked that up to 20%, while we also took our forecast for U.S. economic growth, fourth quarter annualized, from 2.2 to 1.7. So a 50 basis point reduction in economic growth, a slight bump in inflation to account for tariffs, and then a modest increase in recession probability. That's kind of our base case, and very much a function of what was just mentioned, which is tariff uncertainty is having a corrosive effect on capital spending plans. It's constraining some M&A activity in the market, and probably starting to weigh on consumer confidence.
You got to wonder whether what Powell said was actually good for the market. You take a look at the reaction in the equity market. It seems like, it's good news, but he actually cut his projection for growth.
Right.
He raised the projection for inflation, and there's a higher risk of a recession. So what's going on here? I'm not quite understanding why this is all good news for markets.
I mean, that's absolutely right. But the difference, of course, is that what you said is the sort of what's actually happened. We have to understand what the market was already expecting, and I think that what Chair Powell said was pretty much what the market had already discounted and was expecting. I mean, as I mentioned, we've taken our numbers down. It looks as though some others may have cut their GDP forecasts as well. So the idea that there's a somewhat higher probability of recession and somewhat lower growth and higher inflation because of tariffs, I think the market knew that, and the S&P had corrected, as we know, 10% from its recent high in February to the recent low. It's now off 8% from that high. So I think that, at least for the short term, the market had priced that in, and therefore, when it was sort of a result from from the Fed, including the conference, that was exactly as market expected. Market said, okay, it's a relief rally, and we could trade up on that.
You know, you talked a lot about how it was what market expected. What he also said was, we're at a place where we can cut or hold. He didn't see anything about a possibility that he could hike.
Right.
So that's a relief, right?
Yeah. So if you go back to what was the market was expecting, what the chat was in the market at the beginning of this year, the market was pricing 0 to 1 cuts, and there was talk, as you just mentioned, about a hike, and that was when the whole U.S. exceptionalism narrative was very much in force, which is basically there's going to be deregulation, you're going to have increased economic growth. Yes, you might have tariffs, but it's going to be worse for the rest of the world than for the U.S. A bit higher inflation that might require the Fed possibly to raise, which was in the narrative at that time, and the dollar was strong. And you fast forward till today, and it's the exact opposite. You've totally taken out any of those U.S. exceptionalism price gains, most notably in Tesla. You've had the market expectation of Fed cuts going to 3, and now it's backed off to about 2.3 or to 2.5 cuts. You've taken down growth expectations, and now the market's focus is less on inflation from tariffs, but more on the uncertainty and the impact on growth. And I think that's why the whole narrative has shifted. So I think that any talk of Fed hike is really off the table right now.
So we're seeing a lot of repositioning and, you know, investors cutting their position in the U.S. Does that necessarily mean that Asia will benefit from that?
So it's a great question, and we've had tons of investor interest on this. And I think the simple way that we like to describe this is if you think of a chart where the x-axis is S&P performance and the y-axis would be flows into Asia or emerging markets more broadly, the chart is like an inverse smile. Why? Because when the U.S. is doing very well, S&P, then everyone just wants to focus there, and like who needs to care about going anywhere farther afield. When the U.S. is doing poorly, i.e. a correction of 10% or more, it tends to drag everyone else down with it. We've got some great numbers on that to exemplify that. But in the middle, when the U.S. is just kind of range trading, then the narrative would be, well, you know, fundamental conditions are okay, but we're not making money in the U.S., therefore maybe we can take some risk elsewhere. That's the sweet spot for money going elsewhere. So I think that if we fast forward that till today, if the U.S. can sort of stay in this, not really doing so well, but not really collapsing, then I think that's going to add some tailwind to the narrative that money can start seeking returns farther afield, as indeed it's starting to nibble in Europe, for example, and we're starting to see in our investor conversations a lot more interest from parties that previously were completely disinterested in China coming back and asking us about China.
So is it about money going to China now, less so the rest of Asia, or money going to Japan possibly as well?
There's definitely not money going to Japan. Japan publishes daily net foreign flows, and the reality there is that all the net buying that took place in late 2023 and last year when the market was taking out its 34-year highs from 1989, all that money has come out. We've got a great chart, and that's hard data from the Tokyo Stock Exchange. So that money is out. So foreigners are basically de-risked there. Certainly from our flow desk, we're seeing more interest coming in from foreign investors into China, but it still is fairly moderate. Let me give you 2 data points. Number one is hedge fund positioning, where at the start of this year, they were at the 7th percentile of their 5-year range. They got up to the 33rd percentile a few weeks back, but they've taken some profit and backed off to about the 20th percentile. Mutual funds, which is a larger universe, which we get a little bit more lag data for, at the beginning of the year, they were at the 7th percentile also of their 10-year range. They've now increased that to about the 15th percentile, but still very low relative to where they've been. So there's some signs of people sort of inching back into the market, but not really in full force.
All right, because there's lots of uncertainty. Tim, hang tight. Tim Moe of Goldman Sachs is sticking around. Well, still ahead this hour. Once touted as a haven for investors to navigate Trump's tariff wars, Southeast Asia has all but lost that appeal. We take a look at the region's economic woes next. Keep it here with us. This is Bloomberg. Welcome back. The Philippine Central Bank governor says he sees only a modest impact from the global tariff war, but Ali Remolona told me exclusively that the level of uncertainty this time around is much higher. What assumptions are you making about what the Fed may be doing and the impact on the currency, the dollar here?
What we've seen so far is not so much what the Fed has been doing. What has The big factors have been geopolitical risk. When there's an event that makes people worry about geopolitics, then the dollar strengthens. It's a safe haven currency. Even now, it's a safe haven currency.
But what do you see the Fed doing? Some suggesting it will cut 3 times this year, 25 each time. Do you make that assumption as you look at your own monetary policy?
We just follow what the market says the Fed will be doing. And so the market is now saying 25 basis points in June. So in our models, we stick that into our model and see what happens.
There are also murmurings that perhaps the U.S. economy could be headed for a recession. Do you see that? I
don't see a recession, but I think a slowdown is very, very likely.
And of course, this is against a backdrop of tariffs imposed by the Trump administration. Might that have ripple effects on the Philippine economy?
Oh, absolutely, absolutely. The tariff war is likely to slow down growth for everybody and then raise inflation for everybody. By how much, we don't really know. But the bigger factor is the uncertainty itself. A change in tariffs, we can stick that into our models and then we can act on that basis. But the atmosphere of uncertainty is very different from this time. So that's harder to get a handle on.
So how badly might that hit the Philippine economy? Would it derail perhaps your 6% target, which you're confident of achieving?
The baseline calculations that we've made suggest a very modest hit on the Philippine economy. We'll be hit somewhat because we're part of a global economy.
And that was Philippine Central Bank Governor Remolona speaking exclusively to Bloomberg's Haslinda Amin, that's me. Well, Southeast Asian markets are also in the spotlight after the plunge in Indonesia's stocks earlier in the week. Thailand and Indonesia, 2 of the world's worst performing major benchmarks this year. It's a big shift for a region once touted as an investor haven from trade wars. Philippine Huang is here to help us unpack all of that. And of course, it doesn't help that these are all emerging markets. When it's risk off, they get sold off.
Yeah, so there's a bit of a double whammy, right? And it was interesting how they, for a while, had been enjoying a sort of safe haven appeal because of an alternative to China and its supply chains. And at the same time, for many of these markets, their economies were able to strengthen their trade, their investment links with both the US and China. But Tariff War 2.0 looks a little different. And I think traders are coming to terms with that. The idea that Trump is being hostile to all trading partners, potentially reciprocal tariffs, sectoral tariffs coming into effect 2 weeks from now. And the sweeping impact of Trump's policies, I think, is what has gotten investors really worried. So when you look at some of these EM Southeast Asia markets that have been bearing the brunt of the selling, not only are they underperforming China, which has been enjoying being bought up by the AI game, they are also, if you look at the major benchmarks globally this year, out of the bottom 10, 3 of them include those from our region: Thailand, Indonesia, Malaysia as well. Now flip the board, we're certainly seeing global funds leaving in droves. And if you look at the fund outflows, we're on track for some of these EM markets for a 6-month of outflows, not as bad as the 8-month streak in 2021. And indeed, some calls on dip buying after the recent drops have emerged. But for many of these markets, it's not just the external headwinds, it's also the domestic concerns. You look at Indonesia, where the president has consolidated or is trying to consolidate power. That's raised some concern. In Thailand, when it comes to the high household debt levels, as well as corporate scandals. In the Philippines, with the recent arrest of former President Duterte. So I think that also kind of exacerbates the worries and is a reminder to some of the risks in involving or investing in EMs in the region.
And that's always been the case for emerging markets. It's a tough spot to be. Victor Huang, thank you. Tim Moe, still with us, Chief Asia Pacific Equity Strategist at Goldman Sachs. He recently reset his market ratings in Southeast Asia. It's tough being an emerging market. I mean, Malaysia went from among the top performers last year to among the worst performers this year.
Indeed. So I think a number of good points have just been made. The first is that the ASEAN markets, sadly, are illiquid, and therefore, to attract investors to go into them, you need to have an even more attractive investment setup than you would for a larger and therefore more liquid market. And with China attracting all the attention right now, and it's up 33% from its low in early January and up 24% for the year, and it's a big and liquid market, that obviously has attracted investor attention. So if the attention is focused there, then it's much harder for the smaller ASEAN markets to sort of get any kind of time in the spotlight. So that's number one. Number two, I think it's important to understand that there are significant differences. We talk about ASEAN, but there are growing differences, I think, between the fundamental outlook for them. So we've recently raised our view on Singapore, which I think is arguably the more it's obviously the most developed, but also arguably the least risky or the least volatile of them, and sports a very attractive dividend yield. And there's an effort by the MAS, which we've just written about recently, to apply some of the learnings, I guess, from Japan and Korea in terms of the value up programs and better corporate governance to try to galvanize the market here. And so that, we think, has led to a configuration which is attractive in risk-adjusted terms, particularly on the dividend yield side. Also think the Philippines is trading very, very cheaply right now, so we're overweight both Singapore and the Philippines, but for slightly different reasons. Thailand, where I recently was a couple of weeks ago, we think has arguably some of the greater structural challenges in terms of demographics, maybe kind of missing some of the changes and developments in terms of the global supply chain, where it's played a very strong role in past years, but maybe is struggling a little bit more now, along with household debt and so forth. So we think that structurally Thailand has some challenges, and it's an underweight for us. And then we took our view in Indonesia down, really to reflect a reduction in our growth forecast, an increase in the fiscal deficit, and recognition that the banks have, at least for the near term, have a tight funding environment which put pressure on them, which really is the cascade effect from a strong dollar putting pressure on the rupiah, which means that domestic liquidity needs to remain tighter, which presses margins in the bank. So with the bank 60% of the index, that's put some pressure.
The thing is, Tim, when you're investing in emerging markets, you have to be comfortable with political noises, for instance, and you certainly see that in EMs in this part of the world.
Correct.
When investors invest in these markets, they talk about growth potential. And when it comes to growth potential, we're talking about 6-7% in this part of the world. It's hard to get that kind of growth anywhere else. You talk about valuations, they're looking so cheap. I don't see why this part of the world is not looking attractive to someone sitting in the U.S., for instance.
I mean, we broadly agree with that, and that's one of the reasons why we think the Philippines is overweight right now. It's the smallest and least liquid market, but it's trading about 10 times earnings, which is 2.5 standard deviations below its normal range, and we agree with the longer-term growth potential there. So as long as the broader macro framework is conducive for realizing that growth potential and transmuting that into actual manifested growth, particularly the corporate profit level, then I think that argument stands. I think where investors are now is there's so much uncertainty in the world, and we've talked about the rise in global uncertainty and U.S. trade policy uncertainty and so forth, that there's generally a more cautious attitude. And in that sort of environment, people will naturally gravitate towards larger, more liquid, and less volatile markets. And so I think that the appetite to go farther at the risk curve, which is where many of the smaller ASEAN markets are, that appetite currently is suppressed.
Larger market, China. Right,
yes.
But higher risk as well.
Correct.
How much of what's happening with emerging markets in this part of the world has to do with how money is actually gravitating towards China?
Well, there's definitely part of it, Haslinda, and we have a lot of conversations or questions from investors about, which effectively assume that money is in a closed circle. In other words, that if China's going to go up, you've got to sell India or Japan or some other market in order to pay for that. That's partly true, but it's not completely true. And the reason is that if you look at the amount of money that's being run, in broad terms, if you say look at a universe of global mutual funds of about $3.4 trillion, about 900 billion of that is run into either Asia or EM. but $2.5 trillion is run into global of various kinds. So people could buy China by selling Brazil or Turkey or Germany or UK or whatever. They don't have to sell India or Philippines or whatever. So the point is that there is some closed circle aspect where people are kind of rebalancing portfolios more towards China, which is 30% of the EM benchmark. But there is other money that's available to come in that does not necessarily have to sell the other. So our overall view is that you really need to start with looking at what are the growth and valuation opportunities in all the different markets. Set your course that way, and then adjust for where you think flows would be as a sort of an icing on top of that, layer on top of that cake.
When you speak to your clients, do you sense that there is greater or less risk appetite?
There certainly is more renewed risk appetite for China now. That's a function of the AI news and so forth, which you can go into, but we probably don't have time to right now. And also, the reality is that when prices go up, the narrative changes. So, for example, I was in Hong Kong last week, seeing a number of investors and interacting with some people I've known for a long time and who are experienced in the market. There are beginning to be questions around whether there's a more medium-term investment case for China beyond just kind of a tactical rally case, which was what happened a couple times last year. So I think as the market goes up and as the news flow comes out, particularly around the AI effect, that's starting to prompt questions about whether this might have a bit more legs, and that in turn helps to spur some risk appetite.
So I know that Goldman was among the first, to suggest that you buy into China. How much more upside do you think there is?
Well, we have a target for the MSCI China Index of 85, and looking at today's pricing, it's about 10% up from current levels. We actually raised that. We started the year at 75, raised to 85 because of this AI theme. But if you look at the ingredients of that, which are a 12 times forward price earnings multiple target, and B, 9% earnings growth, those aren't outlandishly wild numbers. So, could we see China trade up to 13 times earnings? That's perfectly possible because markets never just go to where your target is. They either overshoot or undershoot. So I think that 10% is, we think, very reasonable and fundamentally supported. If there's a bit of a correction, which we've been thinking might happen after the market's 30% move, that would give you a better entry point. So our point is that we think there's at least another move up in China before you've got to say, well, is all the good news priced, or do we have to raise our numbers further in order for that to sustain?
Is there a reason for you to reposition for April 2nd when those tariffs come into effect? I mean, how do you look at that? How do you price it in? How do you position?
So it's a great question, and it's super top of mind. I've written a bunch about this, and the point we've been making is that there's a risk window around early April, and we've been suggesting that investors might consider overlaying their core portfolio positions with some sort of a hedge around that time frame. So you can have some sort of target hedges, whether it's a put spread or something with April expiry, that kind of stuff. And we think that's a sensible thing to do because you just don't know quite how markets will trade. There is conversation in the market you should be aware of as to whether April would be either a risk event or perhaps a market clearing event. Like, if markets have traded off as the U.S. has done, and then it turns out that the incremental tariff news isn't quite as bad as people have been fearing, then the narrative might be, well, now we know what the rules of the road are, and markets could rally on that. Conversely, if you have a market which has gone up a lot, for example, China, and you get worse outcome and continued uncertainty, then that might be an opportunity for people to say, look, let's correct. So we think if you're not paying too much to buy some extra insurance around this very clearly defined risk window, that's a sensible thing to do.
Tim, always great to have you with us. Tim Moe of Goldman Sachs. Now we have some breaking news. NVIDIA planning to spend hundreds of billions in the U.S. in the next 4 years, and that's according to the Financial Times. We'll bring you details as they come along. Still to come, Tencent plans to sharply increase spending on AI in a bid to keep pace with rivals in the era of DeepSeek. We have analysis next. Keep it here with us. This is Bloomberg. In case you missed it on Bloomberg Insight. When you talk about India's economy, can it get back to 8%, or is 8% a blip?
We are realistic in projecting a minimum achievable growth rate of 6.5%, which is the fastest rate among major economies.
The growth will only accelerate over a period of time. Last year we grew at 8.2%. This year's growth probably will be 6.6, 6.7%. But I think in the next 2 or 3 years, we will certainly get back to a much higher growth rate.
But the government has to keep focusing on growth, and if growth stalls, or by stall I mean stays at the 6% level, they need to do some more stimulus.
There is this recognition to build India for the next 5 years, 10 years and longer. And that's why if you look at the next set of investments that the government focuses on, these are also large employment driving sectors.
Don't miss the next Bloomberg Insight. Welcome back. You're watching Inside. Tencent shares under pressure in Hong Kong today, despite the company reporting its fastest pace of revenue growth since 2023. It also outlined plans to sharply raise spending on AI infrastructure after posting a solid beat in fourth quarter revenue and net income. Let's bring in Bloomberg Intelligence senior analyst Robert Lee. And Rob, yes, it was a beat, but it disappointed in some ways.
Yeah, well, I guess there's an old stock market adage, buy on rumour, sell on fact. So these were very strong results, but well anticipated by the market. I think they beat at the bottom line at the adjusted net income level by just under 4%. So it's a beat, but it's not a spectacular one. And then in terms of what they said on AI, compare and contrast with Alibaba, we didn't see that sort of big bang, spectacular, we're going all in on AI type view from Tencent, which I think sort of ties in with the very conservative, more steady state nature of their management team and the business. So, the lack of any incrementally positive news, I think it's no wonder that you're seeing a bit of profit taking this morning.
Rob, not the big bang kind of spending on AI, but still rising spending on AI. I mean, you got to ask the question, how does it protect its margins, what it means for profitability down the road?
No, that's a very good question, because ultimately, when you're spending on capex, it's obviously going onto the balance sheet, and then over time that will fall through to an increased depreciation charge, and as you've just said, potentially pressure your margins. But I think, again, compare and contrast between Tencent and Alibaba's strategy in AI, Tencent is more focused on potential near-term gains, I should say, by applying AI within its own business to try and drive cost savings and therefore protect those margins. Whereas you compare with Alibaba, they're more focused in trying to go for this long-term holy grail, or achieve the holy grail of something called AGI, or artificial general intelligence. That's something a lot of the big US tech platforms are gunning for, but it remains a somewhat distant prospect, a somewhat uncertain prospect, and is very unlikely to deliver any short-term gain. So I think the gains that Tencent delivers through applying AI internally should hopefully offset any impact from a increased depreciation charge.
Right, we know that when it comes to Tencent, it is reliant on the very scarce NVIDIA chips. The question is whether it uses it for itself or for its clients. I mean, what's the argument for one or the other?
Now, that is a really interesting point, actually, and it came up on the call last night. Now, if we had this conversation 18 months ago, the big concern for all the big tech platforms in China at that point was the potential issue that a shortage of NVIDIA chips might cause them because of the US export controls. Now, they appear to have successfully circumvented those potential issues or bottlenecks through various means. But on Tencent's call last night, they did mention, because of the redeployment of their data center towards internal purposes, that led to a shortfall in the amount of available capacity for external cloud clients. So that did impact their cloud revenue, but didn't have a material impact at a group level. So I think that raises the issue again of the potential bottleneck on supply of NVIDIA accelerators, not just for Tencent, but all Chinese companies, and raises the question as to whether that supply constraint is going to impact their growth potential through this year and into next year. So I think that is something to keep an eye on through the rest of 2025.
Rob, how about its marquee games business? How much momentum is there?
Well, again, if you wind the conversation back, if we talked, as we probably did about a year ago, there were real concerns on Tencent's domestic games business. It's a very saturated market. Obviously, there are macroeconomic pressures, et cetera, et cetera. And then seemingly out of nowhere, the company partnered with Nexon in Korea and developed DNF Mobile, which was a real smash hit title last year and really helped deliver that extra upside on Tencent's earnings for the full year, as we saw yesterday. But looking forward, in the absence of any obvious future big hit, I think their growth will normalize and revert to the norm, really. So, which is why at the group level, I think based on consensus and our numbers, the growth, earnings growth from Tencent is going to average at the 10 to 12% range this year, as opposed to something like 44% last year. So again, they're coming off a real high. It was a spectacular year for them. That's known. It's in the price. And then as growth normalizes, we'll have to wait and see how things develop. Where's the big new hit? It's for them to deliver.
And of course, we've seen a spectacular run in Chinese tech, including Tencent. What's the sense out there? Is it like to see some correction? And would that correction be a good opportunity to be buying into tech stocks like Tencent?
Okay, well, as you know, I know you're an avid reader of our research on the tech team, Haslinda, and we published, as you know, a in-depth, deep dive report on the China AI sector back in November last year. A full 50 pages, sorry, I don't mean to exaggerate, 48 pages of in-depth analysis and research on Chinese AI, including a lot of commentary on DeepSeek. So thank you for letting me get the plug in there. But the subtitle on that note was AI, China AI, progress, not profit. So I think there's plenty of evidence out there. Almost day by day, we see a new model coming up. Chinese companies are very well positioned and narrowing the gap with the States, and they're making strong technological progress. But the question of monetization and the profit outlook for the sector remains very unclear and indistinct. So, obviously the stocks have rallied in anticipation of earnings upgrades. That has yet to come through to any significant extent, and I remain actually quite cautious and doubtful we're going to see that this year. So progress, full marks on that, well done. Monetization remains a real challenge, not just for Chinese AI companies, but I think for AI companies globally.
Great work as always, Rob Lee, Bloomberg Intelligence Senior Analyst. Now, Kai-Fu Lee, CEO at O1 AI and chairman of Sinovation Innovation Ventures, says both the U.S. and China will have winners in the AI race. He told Bloomberg that tech companies leading the AI boom shouldn't distract from the dozens of smaller firms competing.
I think China will have 3 winners. U.S. might have 4 winners at the end. Doesn't mean dozens of others will not want to compete. So I do expect frequent releases to continue especially from the fast-moving companies. And I think the fastest-moving companies probably are XAI's Grok and DeepSeek. I'd say these are the fastest.
And while tensions with the U.S. is casting a shadow over Chinese tech advances, AI startup Manycore says it's looking to grow its global presence. Manycore is known as one of the country's 6 little dragons, companies that have transformed Hangzhou into an innovation hub. Co-founder Victor Huang told us exclusively how the designation has changed the conversation with customers as well as investors.
We are very happy to be one of the 6 dragons, but I believe there will be more and more high-tech companies to be famous like us. It's also make us easier to get in touch with potential customer. And before many people in the embodied AI industry, they are not know who you are and what is Manycore Tech, but now it's make us much easier to introduce ourselves. They are going to just more willing to try our solution.
How many more people are also now approaching Manycore to work for the business?
Before, it's very hard to hire the talents just from top university. Right now, I think it's totally changed. Just the people from all over the world and from all the China, the top talent, they are going to get in touch with us. They are send a resume to us, want to join us. And during these 2 months, many top talents from like Tsinghua University, Zhejiang University, Beijing University, even from Stanford, Harvard, they are sent resume to us. Then some of them already join us. I'm really just feel really amazing about the current situation.
I want to ask about your customer partnerships, because one of those for Spatial Verse is with Agibot, which is a relatively well-known robotics startup from China as well. How does it work in practice exactly?
If you are going to training robot in physical world, it's really hard. Normally, you need more than 10,000 scenes for a robot to training one small action, or we call it small AI model. But 10,000 physical room or physical space is really hard for AI training in real world. Can you imagine you need to find 10,000 space in Hong Kong? I think it's mission impossible. But in real world, you can not only have 10,000, you can have 100,000 or a million. It's easy. I make an example. Just in the physical world, if you want to make a space, you probably need to spend like at least 100,000 Chinese yuan in China. In Hong Kong, it's probably need $1 million. But in virtual world, like for our system, it's probably less than 1,000. So it's much cheaper and faster.
Talk to us about also, you have plans to expand more globally. So what exactly does that look like for Manycore?
We have the users from more than 200 countries and regions. We have a local team American, Korea, Thailand, Indonesia, Malaysia, just more than 10 countries. We have local team to serve them. So the globalization are different, but our global business is also growing very fast, especially for the freemium model.
And that was Manycore Tech Chairman Victor Huang speaking exclusively with our very own Annabelle Drewlers. Well, still to come, the new CEO of Pakistan's Crypto Council will be joining us to discuss integrating blockchain technology and digital assets into the country's financial system. Keep it here with us. This is Bloomberg. Now, the Philippine Central Bank governor says he's not worried about a potential influx of Chinese goods as the tariff war reshapes global trade and supply chains. Here's more from my exclusive interview with Ali Remolona.
Oh, when China does well, everybody in Asia does well. We trade with China. We import most of China is our biggest source of imports, and we also export to China. So China's growth is good for us.
Mm-hmm. Are you convinced with its recovery story?
We'll have to see. I think.
What are you looking out for?
More sustained recovery. We're hoping they get a handle on the property price bubble.
So the property sector is still what's key for you?
Yes. I think that's still the main risk.
In my conversation with several central bank governors in the region,
yes,
they've expressed concern about China dumping cheap products on the back of the tariffs that were imposed by the U.S. on Chinese products. How are you assessing the risk of that happening in the Philippines?
We don't see that happening to us. Because we're already importing from them, so it doesn't really make sense.
What do you see China doing in the coming months, perhaps, to boost its economy further?
Oh, yes. They've been making a big effort in that direction, and I think it will have an effect. It will work to some extent.
And that was Philippine Central Bank Governor Ali Remolona. Let's do a check on how cryptos are doing. Bitcoin, Ethereum, Solana, among those we're watching out for in the latest of several enforcement actions on cryptos that have been abandoned by the Trump administration. Bitcoin currently up by 0.7%. Ripple CEO Brett Garlinghouse says the SEC has dropped its case against the company over its XRP digital token.
The SEC has abandoned their appeal, and so they filed suit in December of 2020. We won on the key parts of the case in the summer of 23. Judge Torres made a ruling that XRP in and of itself was not a security. That's almost a verbatim quote. The SEC filed an appeal about 8 months ago, and what they've now agreed is that they're going to drop that appeal.
Now, the Trump administration's creation of a Bitcoin strategic reserve, as well as a digital asset stockpile, seems to be inspiring other countries. Pakistan is taking steps to position cryptocurrency as a key asset in its push for a digital financial revolution. It's launched a national crypto council to regulate and integrate blockchain technology and digital assets. Our next guest has been tasked with advising the finance minister on this process. Let's bring in Bilal bin Saqib, CEO of the Pakistan Crypto Council. Bilal, good to have you with us. Why and why now?
Well, why not? Because if now, then never. As you were rightly mentioning, Trump's return is the biggest bullish catalyst for crypto in history. Today, he makes history as the first sitting U.S. president to speak at a Bitcoin or crypto conference in New York. And I think, Trump is essentially flipping the script. Trump signed the executive order instructing regulatory bodies to accommodate digital assets, forming a White House crypto advisory team, creating a U.S. strategic Bitcoin reserve. And, we have to understand what that means, is that means that the largest economy in the world is creating it like a valuable national asset, similar to how it stockpiles gold or oil for economic security and strength. So this is why I think the U.S. sets the tone for the world. Trump is making crypto a national priority, and every country, including Pakistan, will have to follow suit or will be at the risk of being left behind.
So what's the actual plan now, Bilal? Is it about making cryptocurrency legal, for instance?
So, you see, our plan as the Pakistan Crypto Council is very clear. Pakistan is done sitting on the sidelines. We want to have regulatory clarity. We need to have a legal framework that is pro-business. We need institution adoption. We want banks, we want other enterprises to integrate with blockchain and not fight it. We want Pakistan as a leader in blockchain-powered finance, and we want to attract international investment because Pakistan is a low-cost, high-growth market with 60% of the population under 30. We have a Web3 native workforce ready to build.
But the thing is, give us the details. Would you make, for instance, crypto legal this year? What are the plans for, retailers, for instance, to be trading in crypto?
So, see, Pakistan isn't just discovering crypto today. We've been one of the world's top adopters. In 2023, we ranked third in the global crypto adoption. Pakistanis, there are like 15 to 20 million Pakistanis that hold crypto today. The country possesses billions of dollars in crypto transactions. So, of course, we want to make this legal. We want to have, as I mentioned earlier, clear regulatory framework so we can bring in investments and we can let the ecosystem flourish in Pakistan.
You talked about wanting international investors to come in. What exactly are you planning to allow them to do? Has it got to do with, crypto mining, or what's available? Where are the opportunities?
You see, foreign investors want stability. They want scalability, and they need a clear regulatory framework. So we will plan, or we're working to provide regulatory sandboxes, which will essentially create fast-track systems for crypto startups to operate in a controlled, compliant environment, incentivize Web3 firms. Pakistan offers one of the lowest operational costs, and setting up crypto businesses here are much cheaper than, for instance, Dubai or Singapore. And essentially, we of 200 people and the GDP, which is more than 360 billion. So essentially, it's a very big market for any crypto company to come in and try.
Who are you in conversations with? What's been the reaction so far?
So the reaction has been amazing. We plan on speaking to the UAE to explore, learnings from them in terms of their regulation. We are very closely also working with the Nigerian SEC to see again how what learnings we can adopt from there. We are looking at the models in Turkey. We are looking at Singapore. We are looking at Hong Kong. So we plan to do a lot of MOUs in terms of capacity building, knowledge sharing with all of these countries who are perhaps ahead at the moment.
Are there plans to tax crypto? Because if you're looking at other countries, Nigeria suddenly is doing just that.
See, the government understands that overtaxation kills innovation before it starts. So we've seen this mistake before. India putting a 30% tax on their crypto trades drastically reduced the exchange volume. Our approach will be different. We are advocating for a balanced pro-growth tax structure, one that incentivizes businesses to register, stay compliant, and push sort of more foreign investment into the country and not capital flight.
Bilal, given the optimism and the plans, how big do you think the crypto market in Pakistan would be? Is there a target in the next 2 to 3 years? How big do you think it might grow?
See, with the changing narrative at the top, I think the government finally sees the numbers. 32 billion in remittance annually, $100 billion digital economy potential, and a massive youth-driven workforce which are hungry for Web3 opportunities. Our fintech sector is growing fast, and crypto could supercharge it. So the challenge in Pakistan is not the demand for crypto. The challenge is building the right legal and regulatory framework to unlock its complete economic potential.
Before we let you go, we have to, as someone who's watching the crypto space, where do you see Bitcoin going?
Only one way, and that is north. When you have the president's executive director on digital assets saying that we've talked about ways of acquiring more Bitcoin in the budget, and again, when he's asked that how much do you want? Well, he said that that's like asking a country how much gold do you want? As much as we can get. So with limited supply, with limited supply, the price, I believe, long term is only going to go north.
We shall see. Bilal bin Saqib, CEO of Pakistan Crypto Council, thank you so much for your time today. Now, just an alert to tell you about Hong Kong planning an IPO margin loan cap, and that's amid a heated retail demand. HSI, HS Tech, all in negative territory right now. Of course, the move aims to curb heated demand from retail investors who've been driving the IPO market frenzy with easy brokers loans. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.